Hi friends, today we are going to discuss about amendment made in regards to Ind AS 12. Appendix C has been added to Ind AS 12, which deals with uncertainty over income tax treatment. Moving on to applicability. This is applicable from for financial year starting from 1st April 19. That is, if a company makes yearly financial, the effect disclosure will be seen in financial as at 31st March 20. Why was this amendment done? First is to be in line with IFRS where IFRIC 23 has been added, which is same as this amendment. Secondly, the situation can be very complex when it involves unclear tax laws of different tax jurisdictions, transfer pricing and tax holidays, etc. Therefore, this complexity gives rise to diverse practices to recognize the tax base. Thus, to bring clarity in proper measurement of current and deferred tax, this has been brought in. Moving on to assumptions. As engraved in standard, it is assumed that tax authority has right to examine books and at any time, and tax authority has full knowledge of aggressive tax planning done. This is assumed so that we have to do necessary treatment in our books as would be done by income tax authority. Moving on to threshold, that is when will it be recognized. Key test here is probable. Probable in general parlance means more than 50% chance of a thing or event occurring, and in case of financial statement more than 50% chance that the tax authority will disallow the expenditure or make addition to total income. Therefore, in nutshell, if it is probable tax authority will accept our contention, then one can pass the entry. If not, then effect of uncertainty should be measured. For example, let us take a situation of India, Australia or India, UK DTAA. If a person has paid tax in foreign country and as per DTAA, credit will be available in India, it should be recognized in books or else test of probability should be conducted in case of uncertainty, and the amount of credit should be measured as per measurement method shown in the following slide as given in this amendment. The standard provide that the amount has to be measured from one of the method which provide better prediction. First method is most likely amount, that is ascertaining single most likely amount in the range of possible outcome, or by expected value method by taking weighted average probability. Friends, continuing with the above example of India and other country DTAA, if it is uncertain about the amount of credit the tax authority will actually provide, then one most likely amount should be used, or weighted average of amount, that is expected value, should be derived from different percentage should be accounted. The thing to note is earlier management could use its judgment, but now the liability should be estimated as per best of the above two method which give correct measurement. One more concept enshrined in amendment is changes in facts and circumstances. The standard also give example of this in Appendix C. If there is any change in facts and circumstances and the management thinks due to this an outflow or inflow will happen, then the amount measured from above methods should have to be recognized as changes in accounting estimate by applying Ind AS 8, or if the circumstances has been known after the year end but before signing of financial statement, the the accounting should be as per Ind AS 10, that is it should be treated as adjusting or non adjusting even as the case may be. Appendix C gives few examples of changes in events and circumstances which involve agreement or disagreement of tax authority about the similar tax treatment in different year. This standard goes on to say if there is any legal precedence during the year in this regard for some other company, then also we should account accordingly provide the same in our books. Let us move on to transition provision. Standard gives two methods: fully retrospective, that is changing past fi- uh, year figure or modified retrospectively, that is giving effect to the opening reserve without restating previous year figure. The last topic is disclosure requirement. Good news is that there is no new disclosure requirement. This standard only reiterates that disclosure as per Ind AS 1 and Ind AS 12, which deals with assumption, estimation, and contingency, should be disclosed. Thank you for listening, and let me know if you have any questions.